I think the Fed is on track to make one of the worst policy mistakes they have made in the past 2 decades. In this video, I want to share with you guys exactly what happened in the latest FOMC meeting, what the summary of economic projections show us about the Fed's interest rate hikes and inflation in 2023, and why I think this over-tightening in the market is creating an opportunity to be a continued buyer of stocks. And when someone as historically skeptical as Jeffrey Gundlach also believes the Fed is overdoing it, you really want to pay attention to the data I'm about to show you. But as usual guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, let's look at the summary of economic projections, which is often shared every 3 months, which means the last one we got was in June of this year, which obviously has been a long time coming, and that means the situation has potentially developed significantly since then. And as you can see right on the front headline, the big thing to keep in mind is that the Fed's GDP projections have come down significantly from 1.7% growth to 0.2% growth. Now, the reason why this is not negative, even though we already know we're in a recession in 2022, is because this is a midterm election year. We know that this is a political game, and that means that the Fed does not want to admit that we're in an actual recession, even though the data tells us that we are. And chances are the recession is going to get even more severe with the way and the pace that the Fed is hiking interest rates, which might be way too much given that inflation might already be peaking from a core standpoint, even though, yes, the August CPI came in very bad. You see, the thing the Fed isn't realizing is the fact that monetary policy takes a long time to get priced into the data that they're basing their decisions off of. If you guys remember, back in March of 2020, when interest rates were cut to near zero, we didn't actually get inflation immediately. Inflation in CPI was only realized in about March and Feb of 2021. Which means it took 9 months for the Fed's monetary policy actions of printing money in March of 2020 to get priced into CPI. And we know that we only started raising rates this year in March of 2022, which means that we should expect until early next year to really start seeing some sort of movement in CPI. And the reality is that the US 10-year Treasury is already doing a lot of the work for the Fed by itself. This thing has already rallied significantly in 2022, which is obviously a big reason why the stock market has been underperforming. But this means that overall, there could be more monetary policy being priced in than the Fed is showing us on the surface. And the reason for that is pretty simple. We all know that the Fed's interest rate hike of 75 basis points is only going to affect their Fed funds rate, which is essentially the interest rate that banks are allowed to get money from the Fed. And because obviously banks need to make a profit, they have to increase the interest rates they charge to consumers through auto loans and mortgage rates, which obviously is going to have an effect on the wealth that many people are experiencing. And you know what's really funny? Jerome Powell in today's conference actually admitted he knows that monetary policy works with a lag, and that he cannot control the price of oil and energy and what's happening in Europe. So why exactly is he being so aggressive with raising interest rates, a form of aggression that we have not seen in over 40 years? Well, I think we all know the answer is pretty clear. It's the fact that we're in a midterm election year, and the Democrats are basically struggling to gain the confidence of consumers because of heightened inflation and obviously the Fed's lack of good policy in 2020 and 2021 when they continue to call inflation transitory. So essentially the Fed now is trying to catch up, and again, they might be overdoing it just like they missed out in 2021 to actually hike interest rates and really significantly reduce their expectations hilariously. And for the crowd that says that inflation has not peaked based on what we had with the August CPI, which came in at 8.5% versus analyst estimates of 8.3%, well, as you can see, every single time we've had very bad CPI report market reactions, the market has not immediately tanked in the next 6 months. And as a matter of fact, the market has actually performed pretty well after all these historic market reactions. I sourced this chart from Adam Koo, who is an amazing investor, who is a continued bull and has been sharing some pretty important insights into why it continues to pay to invest in the market despite all this short-term bullshit that we're experiencing, which is essentially what the media is trying to feed you to sell out of your position. Even in 1974, when we had almost 15% inflation, the market tanked and then recovered after we got one of the worst CPI prints in 20 years. I mean, what this tells us is that analysts are either extremely bad at predicting inflation, or that typically when the market has insane volatility, that's when the market actually bottoms. And as you can see, I've seen this insane volatility through my portfolio over the past 2 weeks. XPeng and Nikola Motor specifically have actually been going up and down very significantly over the past week, which tells me that either volatility is increasing and that the risk appetite for the market is decreasing, or we could be near the bottom, as crazy as that might sound. And why could that be the case? Well, as you can see, the VIX has not reached the levels that we saw in June, even though the market has been seeing and giving us volatility very similar to the crash we saw back then. What this tells us is that either we're seeing a bear trap, where essentially we are testing the lows of June and July to take out all the stop losses and rip the market higher when everybody least expects it, or we're simply waiting for another catalyst to capitulate the market in a very short amount of time and then rip the market higher, kind of like what we saw happen in the March 2022 and July 2022 rallies. Now, I have no idea if that rally is going to be what's going to take us out of the bear market, but obviously we will never know which rally it's going to be. So you're much better off betting when the market is going down and continuing to invest in your companies and your index funds than just selling out and trying to predict which one of those rallies is going to lead us into the bull market. And the simple fact of the matter is that valuations today are on par with what we saw back in 2008 and 2009. This is a comparison of the NASDAQ with the 10-year Treasury yield, and we have not seen these levels from a ratio perspective since 2009. And you tell me, would you rather have been a buyer of stocks in 2009 or a net seller? I would have much rather bought stocks back then, along with real estate, even though the real estate situation right now is probably a little bit worse than it was back in 2009 because inflation is high and that is causing the Fed to act. Whereas the stock market, on the other hand, has already been pricing in a lot of this pain over the past 6 months. This doesn't mean we have bottomed just yet. It just means that you should not be selling any stocks unless your conviction has significantly changed in that asset, in which case, obviously, you should let go of it immediately. So if the stock is going down and there's nothing wrong with the business, I will continue to buy or reassess the amount of quantity I want to dedicate to that stock, because chances are I might have missed just the valuation I bought it at. But if the stock is going down and the business is underperforming, then yes, I will immediately let go of that stock. And for the folks that have been saying that higher interest rates means that stocks will never be able to recover until the Fed pivots, which we're not expecting until the middle of next year, well, as you can see, historically, whenever the Fed has increased interest rates, the market has rallied on many occasions. We saw this in 2016 to 2019, and we also saw this between the dot-com bubble and the Great Recession. From 2004 to 2007, the Fed was increasing rates, and throughout that time, the stock market was rallying. And even if you want to compare a high inflation period like we saw back in the 1970s and 1980s, as you can see, once the market realized that inflation is going to peak soon, even though the current data is not showing us based on future indicators, the market did indeed rally, even though the Fed was increasing interest rates. This section right here, I think, summarizes the S&P 500's overall market sentiment really well. Typically, when interest rates are being hiked immediately, the market has this massive reaction to the downside, which always feels like an eternity in the moment. But then at some point, even though the Fed is continuing to raise interest rates, the market starts rallying and completely forgets about that specific catalyst, because obviously it gets priced in. But obviously, that is just my thoughts on the situation, and I'm absolutely not a financial advisor or a macroeconomic expert. So let me know your thoughts down in the comment section below.